Navigating Canada's departure tax, leaving Canada without a proactive legal strategy is one of the quickest ways to trigger catastrophic tax liabilities. Failing to plan ahead for departure tax, form disclosures, and international treaty rules exposes your global portfolio to preventable CRA penalties and double taxation. The legal trigger of deemed disposition. If you are planning to relocate outside of Canada, one of the most critical legal hurdles you'll face isn't border control. It's Section 128.1 of Canada's Income Tax Act. Unlike countries like the United States, which tax based on citizenship, Canada taxes based on tax residency. The precise moment you legally sever your primary residential ties with Canada, the Canada Revenue Agency imposes a deemed disposition. Under this legal fiction, the CRA treats you as if you sold your worldwide capital assets at fair market value on the day before your departure date, and immediately reacquired them at that same amount. This triggers immediate capital gains tax obligations, even if you haven't liquidated a single asset or received a single dollar in cash. What establishes departure? Factual versus treaty non-residency. Before we look at the tax calculations, we have to look at the legal trigger. When do you actually cease to be a Canadian tax resident in Canada? The CRA evaluates this using a two-pronged approach. 1. Primary ties. Do you retain a home in Canada, owned or leased? Does your spouse, common law partner, or dependents remain in Canada? 2. Secondary ties. Did you keep your provincial health coverage, driver's license, Canadian bank accounts, or credit cards? If you retain significant primary ties, the CRA considers you a factual resident, meaning you remain subject to Canadian tax on your worldwide income. However, if you move to a country that shares a bilateral tax treaty with Canada, like the US or the UK, you may qualify as a deemed non-resident under the treaty's tiebreaker rules. Establishing this exact departure date is crucial because it sets the valuation date for every asset you hold. Taxable assets and capital gains math. Once your departure date is fixed, your assets are divided into two primary legal categories, those subject to deemed disposition and those that are exempt. Assets subject to exit tax. Corporate shares, both publicly traded equities and shares in private corporations. Investment portfolios. Non-registered stocks, mutual funds, ETFs, and cryptocurrency holdings. Foreign real estate, any real property located outside of Canada. Interests in trusts and partnerships. Exempt assets, Canadian real estate. Direct holdings in Canadian real property remain exempt from the initial exit tax because Canada retains jurisdiction to tax them when actually sold later. Registered accounts, RRSPs, RRIFs, TFSAs, and FHSAs are excluded from deemed disposition upon exit. Note on capital gains. Net accrued capital gains from deemed dispositions are subject to standard Canadian inclusion rates on your final resident tax return. Post-departure withholding and TFSA pitfalls. What happens to the assets you leave behind? For Canadian real estate, if you rent it out post-departure, payers or property managers are legally required to withhold 25% gross non-resident tax under Part 13 of the Act, unless specific elections, like Section 216, are filed to tax net rental income instead. For registered accounts, like RRSPs, withdrawals made as a non-resident are generally subject to a flat 25% withholding tax, which may be reduced under applicable international tax treaties. Watch out for TFSAs. While Canada does not tax your TFSA upon departure, you cannot make contributions as a non-resident without facing a 1% monthly penalty. More importantly, foreign jurisdictions, including the United States IRS, do not recognize the tax-exempt status of a Canadian TFSA, treating accumulated growth as fully taxable. Statutory reporting, penalties, and deferral elections. Compliance when leaving Canada requires strict adherence to statutory filing deadlines. On your final tax return, due April 30th of the following year, you must submit specific disclosures. Form T1243, used to calculate and report the deemed disposition of your capital property. Form T1161, required if the aggregate fair market value of your reportable worldwide property exceeds $25,000 Canadian. Failure to file T1161 carries a strict penalty of $25 per day, up to a maximum of $2,500 per unfiled form. Tax deferral option, Form T12444. If your exit tax bill creates an immediate liquidity crisis, Section 220.4.5 allows you to elect to defer payment until the asset is actually sold. However, if the federal tax on your deemed disposition exceeds specified thresholds, the CRA will require acceptable security or collateral, such as a bank letter of credit or pledged assets, before approving the deferral. Importance of pre-departure tax planning. Severing tax residency requires strategic advance planning before your physical exit date. Prior to departing, consider obtaining professional valuations for private holdings, utilizing tax loss harvesting to offset accrued gains, and conducting a thorough cross-border review of your legal contracts and corporate structures. To optimize your financial position upon your departure and ensure your compliance with the CRA's mandate, advanced planning with knowledgeable professionals is essential. To learn more about our legal practice, visit our website and contact our law firm to schedule a confidential consultation. Thank you.